Hey, what's up, my friend? So in today's training, you will learn how to combine trading indicators like a pro so you can better time your entries and exits, right? And get better trading results. But first, right, have a look at this chart over here. And tell me, right, what's wrong with this? Well, for some of you looking at it, might be thinking, hey, Rayner, there's nothing wrong with this, man. This looks good, right? Look at the signal of this chart, right? The market is going up higher. Look, this RSI is pointing higher. The CCI is pointing higher. The stochastic is pointing higher. Oh, this market is bullish. It's going up for sure. The problem with this chart is that this group of indicators, they are correlated. They are known as oscillators, right? The way they are calculated, the way the logic of behind these indicators, the math behind it is largely similar. And that's why these indicators, they all move in the similar manner. They are correlated. It's not because the signal is strong. It's not because the market is about to go up higher. It's not because this is a high probability trade, but rather this group of indicators, they behave in a similar manner. When one goes up, the other goes up as well. When it goes down, this one goes down, this one goes down. This one goes up, this one goes up, this one goes up. It's not because the signal is strong. It's because the logic behind it, the math behind it, right, of these indicators are largely similar. And this is a mistake, right, that many traders make when they use indicators. You just splash it all on their chart, right? Looks good, all pointing in the same direction. Oh, this is a high probability trade. Let's buy. The market reverse, they get stopped out and they wonder why, all these indicators, they're all saying the same thing, but, I still lose money. And that's why, right? You can't just splash any Tom, Dick, Harry indicator on your chart, right? It doesn't add value to your trading. It only clutters your trading. The more indicators on your chart doesn't mean that you're going to get, a better interpretation of the chart. You're not going to get, better analysis. It doesn't work that way, right? It's like, trying to get your wife pregnant, right? You can fire one time, 10 times, 100 times. It takes 9 months for a baby to come out. It doesn't mean that, you fire 500 times, right? The baby will come out in 1 month. It doesn't work that way. The more times you fire doesn't mean it's better. And it's the same as this, right? The more indicators that you add to your chart, it doesn't mean it's better. You have to know what you're doing. Okay? So now the question is, how do I combine trading indicators such that it adds value to my trading, such that, it makes sense? That's the question. Okay, so that's what we're going to cover right now. Okay, how to combine trading indicators. And by the way, right, if you're enjoying this video so far, give me a thumbs up. If you don't enjoy it, then hit the subscribe button. All right? So the question is how to combine trading indicators, right? The way to do it is that, the way I do it is that I like to categorize them by their purposes. Some people like to, categorize indicators by their category, like, oscillators, volume, trending indicators, etc. For me, I like to categorize them by their purpose, right? And the way to do it, right, is that you have to know, right, the math behind all these different indicators, the logic behind it. And to make your life easier, right, I have broken down most indicators, right, into one of these 4 purposes, right? Most indicators, right, you will land up in this one of these 4 purposes. The first one is market condition, area of value, entry trigger, and trade management. Let's talk more about it. So for market condition, right, what you want to do is that identify, right, the trend. Identify whether the market is in a range. Identify whether volatility is high or low. There are many indicators for this, right? But to simplify this, I'm only using moving average and average true range because I just want to illustrate the concept to you. So for moving average, okay, you can see over here, this black line over here is the 200 period moving average, this one here. So what this does, right, basically these indicators, it measure historical prices, right? It sums up the historical prices over time. So for example, if prices have been falling, right, it will calculate the average, right, over the last 200 period. For example, 200 period moving average, it calculates the average over the last 200 period, and then it plots out as a line on your chart. So if the prices have been falling over the last 200 period, the moving average will be pointing lower. Okay, so you can use this as a indicator to tell you whether the market is trending higher or lower. One way to go about it is that if the price is below the 200 period moving average, you can say that the overall market is in a downtrend and you want to look for selling opportunities, like this one over here, right? Generally, the price is below the 200 period moving average, then you want to look for selling opportunities. And the opposite is true. If the price is consistently above the 200 period moving average, you want to look for buy opportunity. On the other hand, right, average true range, let's talk a little bit about this. You can actually get out the average true range, like this one here. You can see over here, okay, the color here is quite bad. So I'm just going to adjust this color to help you see better. Okay, you can see this pink line at the bottom. Okay, you can see that now this indicator, the ATR one, is not correlated with stochastic and RSI. And the reason is because they are of different purposes. Average true range, it measures volatility in the market, whereas the other two is just an oscillator that oscillates between 0 and 100. So you can see that over here, the line over here is heading lower over time. What is it telling you? It's telling you that over time, right, from here to here, okay, volatility in this market over here is decreasing. It's nothing to do with the trend. It only measures volatility in this market. Likewise, over here, I can see volatility, getting lower. Over here, you can see that the range of this candle, of this bars, right, getting smaller as well. Over here, on the other hand, right, you can see over here, this portion here, volatility is high. What does this tell you? This tells you that the range of the candles on the chart, right, is large. It's wide, which actually is this part over here. Range of these candles are large. It's wide. So you can see that this is what ATR does. It helps you identify the market volatility, whether it's high, whether it's low, and then maybe you can use it to use the appropriate trading strategy for these different market conditions. Next one, right? Area of value, right? For this one, you're pretty much asking, right, where might potential buying or selling pressure comes in. You can use a tool like moving average or stochastic, right? Let me explain. So for example, this one over here, let's change this to the 50 MA because you can see it's a healthy trend. Notice, right, how the price respects the 50 period moving average. It finds area of value at these lows, this lows, this lows, and this lows. So this 50 period moving average is acting as an area of value where potential buying pressure could come in. Make sense? And likewise, you can use a tool like stochastic as well whenever the price is below 20, right? This could be an area of value as well. Here, 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 and here. Okay, so these are two different indicators to help you identify area of value on the chart. In essence, right, area of value, it's telling you, right, where should you be buying, right? Should you be buying at the lows, right? Which part of the lows, right? So area of value can help you identify, what is low in the market. Whereas the trending market, the tools to identify the market condition, it tells you what to do. Should you be buying or should you be selling? Area of value tells you where to buy, where to sell. Moving on, entry trigger. So once you have your trading setup requirements, let's say it's there. What is the trigger to get you into a trade, right? For many traders, it can be as simple as candlestick patterns. Maybe it forms a hammer, it forms a shooting star, whatever. But you can also use indicators, right, to get you into a trade as an entry trigger. For example, two common ones are relative strength index, the RSI, or the Donchian channel. So let's have a look, alright? So for example, RSI, you can look to buy, right, when the RSI crosses above 30. So in this case here, RSI, I think here is about 30, right? When it crosses above 30, right, it can be a buy signal on the RSI indicator. That's one way to serve as an entry trigger. If you think about this, right, what the RSI does is that it measures momentum in the market. So when RSI crosses above 30, it's telling you that there is bullish momentum coming into the market, and you can look to buy when it crosses above 30. So this is an objective way to enter a trade as an entry trigger. Same for stochastic, right? You can use it as an entry trigger when stochastic crosses above 20. That's possible as well. And another one I want to share is the Donchian channel. Donchian channel, what it does is that it measures the previous day, the 20-week high and 20-week low. That's by default. So one way that is that if you want to trade breakouts, right, you can use the Donchian channel to help you, get on board, right? Whenever the price hits the upper blue line, it's telling you that it makes a 20-day high, and that could be an entry trigger to enter a trade, right? So this is Donchian channel. And finally, right, the last group of indicators, right, they are used to help you manage your trade. Can help you use to set your stop loss, set your target profit, right, trailer stop loss, etc. You can use the chandelier stop, pivot points, average true range, etc. So again, just to illustrate, let's say we are going with pivot point, right? So this is something that is used pretty commonly, right? I'm just going to fire out the pivot points, standard. So you're going to see a bunch of lines on your chart. Okay, you can actually ignore all the earlier lines because it's kind of irrelevant already. The way pivot point works is that it takes the high, low, and closing price of the previous day and plot out, right, support and resistance for today. In fact, I can just remove all the earlier lines since it's not relevant. There you go. Okay, so all is gone, right? So what this tells you is that based on the previous day prices, right, these are the current pivots for today, right? So you might find resistance at this level, resistance here, and resistance here. You might find support at this level, here, here, and here. Okay, so this is how pivot point works, and you can use this, right, as target profit, right, to use it to exit your trades, right, where you might not have an idea, you know, where should I exit my trade. Pivot points can be used to help you, you know, define your target profit. And also another one is the chandelier crow stop. Okay, so let me just show you what this one means. So this chandelier crow stop. So what happens is that you see this blue line and this pink line over here, right? I'm just going to change this to a 20 period. ATR multiple is 3. Okay. So what happens is that, for example, earlier we talked about the average true range, right? It measures volatility in the markets. So when you trail your stop loss, right, you don't want to set your stop loss too tight because it could be just due to a spike in the normal market volatility and you get stopped out. So one way to go about is use the volatility of the market, right, to trail your stop loss. So what you can do is that you can use the chandelier stop. What it does is that it adds a multiple to this ATR value. For example, the multiple you saw earlier, I used 3 ATR. Okay. So you can see that over here from this lows, right, let's call it X. Okay. You add on 3 ATR. And this value, let's say, is call it Y. And this Y is at this pink line over here, right? This from this highs to this lows is 3 ATR. So what this means, right, what chandelier stop does is that it gives you a level to trail your stop loss, right? So you can ride trends at the market. And you can imagine that as the price heads lower, this pink line will go down lower as well. Alright, so this is very useful to actually, you know, ride trends in the market. Okay, so that's how this indicator works. So now, what is the best indicator combinations? How do you actually combine indicators, right? So the general guideline is this. Number one, you have to know the purpose. What are you trying to achieve with your indicators? Are you trying to define the trend? Are you trying to use it as an entry trigger? Are you using it to identify the area of value? What is the purpose? You must know the purpose. Second thing, right? Only pick one indicator from each category. Earlier, you saw the mistake that many traders make, right? 3 indicators from the same category. Doesn't make sense, right? So only pick one indicator from each category. And try not to have more than 3 indicators on your chart because really you don't need more than 3, right? For me personally, I use just 1, sometimes 2, sometimes nothing at all. It really depends. If you are a price action trader, I would say 1 or 2 indicators is more than enough to supplement, right, your price action trading analysis. Okay, so with that said, let me share with you some examples. Okay, so let's say you are looking to capture a swing in a trending market. You can use these 3 indicators: moving average, RSI, pivot points. Let me show you and I'll explain why. So we talk about the RSI. Okay, I like to use the 10 period RSI because it's more responsive and takes into account 2 weeks of data. This one I like to use 20 period. And we don't need a chandelier case stop. Right, let's remove this. We have the moving average. Okay, are those the 3 indicators? Moving average, RSI, pivot point. Okay, we have moving average. We have the RSI and the pivot point. So I just remove the ATR for now. So let me explain to you what I'm doing with this. You can see that overall, right, this S&P 500, we are using this moving average to identify the trend for us. So since the price is above 200 MA, we can conclude that it's in a uptrend. So we're looking for buying opportunities. Next thing, right, we are using the RSI, right, as an entry trigger to enter a trade. So maybe the entry trigger could be, you know, RSI below 30. Okay, we look to buy. So right now, RSI is still not below 30 yet, right? So if it goes below 30, and let's say it spikes up higher, right, we will buy. Okay, so that's helping us define the area of value and entry trigger. The area of value is RSI below 30. The entry trigger is RSI crossing back above 30. And for exits, right, we can use the pivot point to help us define, you know, where the market might find potential, you know, selling pressure, to help us, you know, define levels to take profit. So it could be the R1, R2, or R3. So does it make sense? Can you see how all these different indicators have their own purpose? Another example, ATR and Donchian channel. So let's say you're looking for a low volatility breakout trade, right? So what you can do is, again, let's say we look at Brent crude oil. Okay, I'll just remove all these indicators, remove this. Okay, so low volatility breakout. So what you want to do over here is, again, ATR indicator, it helps you identify volatility in the market. So you can see that right now, volatility is pretty darn low. It's near multi-year lows. Okay? And the Donchian channel can serve as a trigger to enter a trade. So when you see over here, right, the price, it breaks below this blue line, or rather it hits the low of the blue line. It's telling you that it has made a 20-week low. So this could be a low volatility breakout trade. The price has made a 20-week low in a low volatility environment. And really, if you want to, you know, add in more indicators to trail your stop loss, you can. You can use, like, for example, the chandelier crow stop to trail your stop loss. Or if you want, you can actually use a moving average to trail your stop loss. For example, let's say I pull out 200 period is quite high. Let's say we use a 50 period moving average. Okay, so once you are got on board the trade, right, where you go short on the break of these lows in a low volatility environment, how do you manage your trade, right? You can use a 50 period moving average and exit only when the price closes below it, which is somewhere about here, where the price closes above the 50 MA. So you can see how the moving average, how the Donjon channel, how the ATR indicator, you can combine them, right, and to formulate, right, trading setups. And I hope this makes sense. This is important, okay? So let's do a quick recap, right? Number one, different indicators, they have different purposes. You must know what is the purpose. Number two, you must know what you need, right? Are you trying to identify market condition? Are you trying to manage your trade? Are you trying to identify area of value, etc.? Not more than one indicator from each category, because anything more is just noise. It's adding clutter to your charts. Doesn't make sense. And don't have more than 3 indicators on your chart. Okay, if you're a price action trader and you're using indicators, I would say 1 more or 2 more, it's more than enough. Alright, so with that said, I have come towards the end of today's training. I hope you got value out of it. If you want me to cover any specific topics, right, leave it in the comment section below. If you've enjoyed this video, hit the thumbs up button, subscribe to my YouTube channel, and I will talk to you soon.